What is a cash flow statement? A cash flow statement (CFS) is a financial statement that provides aggregate data regarding all cash inflows that a company receives from its ongoing operations and external investment sources. It also includes all cash outflows that pay for business activities and investments during a given period. The CFS is crucial for understanding the liquidity position of a company, as it shows how well the company generates cash to meet its obligations. By analyzing the CFS alongside other financial statements like the balance sheet and income statement, stakeholders can gain a comprehensive view of a company's performance over time. Importance of cash flow statements. The CFS is essential for various stakeholders including investors, creditors, and management because it offers insights into the company's financial health. Unlike the income statement, which can be influenced by accounting practices like accruals, the CFS focuses solely on actual cash transactions. This makes it easier to assess whether a company can generate sufficient cash to sustain its operations and fund future growth. Key components of a cash flow statement. The cash flow statement is typically divided into three main sections. Cash flows from operating activities (CFO). This section details the cash generated or used in the company's core business operations. It includes cash receipts from sales of goods and services, payments to suppliers, salaries paid to employees, and other operating expenses. Cash flows from investing activities (CFI). This part reflects cash transactions related to the acquisition or disposal of long-term assets, such as property, equipment, or investments in securities. Cash spent on purchasing fixed assets is considered an outflow, while cash received from selling these assets is an inflow. Cash flows from financing activities (CFF). This section provides insights into how a company finances its operations through debt and equity. It includes cash received from invested or borrowed funds, as well as cash paid out in draws or dividends. In summary, a cash flow statement is vital for assessing a company's liquidity and operational efficiency by detailing all incoming and outgoing cash flows across operating, investing, and financing activities.